Okay, it's 2 o'clock, so let's get started. Welcome everyone to this webinar where we will cover one of our credit funds, Pareto ESG Global Corporate Bond. More specifically, we're going to cover the ESG work that is being done and why we think this is important. My name is Matthias Landmark, and I will be covering the first part of this webinar. With me today are my colleagues Stefan Eriksson, Lead PM, and Nawal Bukadroon, ESG Analyst. Just very briefly, before we get into the specifics, Pareto Asset Management is an active investment manager with about 60 employees, about 5 billion euros under management with an even split between equities and fixed income. We have offices in Norway, Sweden, and Germany, but we work closely with clients in several other parts of Europe. We will focus today on the ESG development that has occurred the last few years, but also cover recent Article 9 classification and carbon footprint assessment. Before we get started, I just would like to thank all of you that have dialed in. We are all aware that your time is limited and that there are plenty of other webinars available, so we are grateful that you joined us today. We will try to answer the following 4 questions throughout this webinar. Why global corporate credits? Is ESG important in fixed income? What does SFDR Article 9 mean? And how to measure carbon footprint? There will also be a brief Q&A session in the end of the presentation. If your question is not answered during the webinar, we will make sure to reach out to you after the presentation. Before we get into the investment process and the ESG work, let me just back up a little bit and tell you about the background, the goals, and the target of the fund. The mandate is to find global exposure in the corporate space within conservative high yield. With a global mandate, we have a large investment universe that enable us to find market leaders with a solid business model, and at the same time making sure our holdings have a sound ESG profile. When we established this fund in 2015, a key goal was to maximize risk-adjusted return. And in order to do this, we focused on companies with fundamentally stable business models and avoided companies and entire sectors which we defined as boom bust. These extremely cyclical companies and sectors have in common that they are very sensitive to external price shocks, which we do not like. The clearest examples being fossil energy and oil-related companies, but also mining companies where the raw material prices affect the company's revenue in a correlated way. This avoidance evolved over time to match the ESG framework that was introduced a few years later with a Nordic eco label in 2018, which we will come back to in the presentation. But important to note, the objective from the beginning of the fund, and still is today, is to deliver good risk-adjusted returns in the corporate credit space. And very briefly, the numbers. Depending on currency, the yield to maturity numbers are currently ranging from 3 to 4. Average coupon, which drives the fund's performance, is 4.5 currently. Duration is at 2.2, and the last few years it has moved between 2 and 2.5. Just like the numbers indicate, the fund has a conservative high yield profile with a reduced interest rate duration, and therefore less affected by long-term rate moves. Last year obviously was a roller coaster, especially with the volatility in March and April, but we managed to finish in the 2 to 3% area, depending on share class. I hope you got a basic overview of the fund and what its goal, mandate, and risk factors are. And now I will hand over to my colleague, Stefan Eriksson, who will continue the investment process and also how our ESG work has evolved and how we use this information in the decision-making process. Stefan.
Well, thank you very much, Matthias. And welcome all. We're happy to have you a part of this webinar here. So ESG in fixed income and ESG in our product per se, is that important? Now you could actually pose the question, is ESG overall important? And I think we we all agree that it does have a tremendous impact in many aspects of the entire spectrum, both E, S, and G, and that's why we focus on all three. We see also that people can make a change and make a difference. We've had the Greta effect that came just in the recent years, how a 15, 16-year-old can drive debate across the world and actually have meetings at the United Nations and holding a speech there is something that maybe not any one of us would have suspected or had thought was possible. So I think the new technology and the new world, in order to reach out with your message, is both good and bad. So I think technology drives a lot of this too. In terms of us, so let's step back down from the big scene and focus on Pareto Asset Management and then what we do in the fund here. It kind of goes back to the same thing though. We do believe that we can make a small difference, and it goes hand in hand that we and each individual person in the private life can also make a difference. So we apply ESG analysis into the investment process, a little bit similar to one would do in corporate credit analysis or in regular equity analysis. There are a lot of hard facts and numbers. We live by numbers in a predominant way, but there are soft factors. Soft factors do govern. We are human beings with all its positives and negatives that are driving our society forward. So with that in mind, we apply also the same thing in our ESG analysis. There are hard data, there are certain third party one can use, but we also use our soft factors, and then we look at every single investment in totality as well. To summarize, with a global mandate, we can evaluate then a multitude of factors, and this is truly the part of integrating ESG in the decision process. As I mentioned, soft factors, be it ESG or the management plan or whatever, is all part of what we believe is going to drive a company forward. So as we see here, we see some negative selection criteria. Many of these have become hygiene factors in the past few years. And so for us, what we have a little bit more, and we're going to cover that with the Nordic Swan Eco label, that is kind of the foundation, and that was the license that we achieved in 2018. That is the foundation of kind of the exclusion and selection criteria. We also have a lower selection to real estate and financials. That's not necessarily out of an ESG perspective that those sectors are whatever qualified as bad or anything like that. But it is that the portfolio since start, and Matthias touched upon it there in the beginning, it is a corporate exposure that is by far the most important aspect of this fund. And then of course we have over time then of course professionalized and enhanced the responsible investment guidelines. Now the more exciting and maybe it's more interesting to talk about positive just because of the word too. It may mean something positive in that sense. So we do like this aspect where we try to find companies instead of just excluding a lot of companies. What type of companies do we like to invest in? And there we also, apart from this, we try to focus on companies in the middle part of the value chain. And that's what's kind of driving our world forward here. So they may not be a large part of the total cost of a final product, but they're hugely important. And I think in the last 40, 50 years, we've seen how logistical chains have evolved over time. And we've seen examples how that can be interrupted too in the Suez Canal. So these companies are extremely important. But there's another interesting aspect when we talk about ESG, is that these companies are pressured from the top. Let's see where my hand is here. There. From the top, but also from the bottom here. So they have demands on them from their end clients with the companies with very big goals and so forth. So we see that many of these companies have very clear goals, but maybe limited somewhat. So they're trying to walk the talk maybe a little bit more. Now, there's not a pure science to this, but in the past 5 or 6 years, we have met and observed and invested in a number of different companies, and there is a slight difference in the approach. It's also a little bit because you are not out there in the media eye to the same extent, also for good and bad. And there we see that they don't really have a choice because the demands on the client is pretty hard and strict. So they have, most of the time a fairly strong ESG profile to start with. And they often try to find solutions for here and now. In short there, maybe a slightly more defined ESG target based on the clients. They walk the talk slightly more. So it kind of fits a little bit to what we are looking for in our fund as well. And therefore then our hybrid approach to the analysis we believe is valuable, especially for fixed income. As we speak then about fixed income, I mean the word in and of itself, a fixed stream of income has been the basis for so many years. And we can remember or read about it as where interest rates were a while back. Now, that's not the case at the moment. So the last 10 years of quantitative easing and central bank support by lowering interest rates in order to enhance inflation and growth has put us into this picture. Now, we're not going to delve into every single aspect of the fixed income bonds that are available in Europe, but this is a snapshot of every single category of Euro bonds there are, and there we see the big zero where most of these bonds evolve their yield around. So we're sitting in this zero interest rate environment that we heard about, and negative, of course. We're in many parts of the world we have negative interest rates. Now, there is then very little cash return, and that goes back then to what Mattias said. We're trying to have an approach where we look for corporate bonds with a decent cash return while still having a sustainable business model. So we're choosing a little bit of a middle of the road type of strategy here. So you can either apply leverage or extreme illiquidity in order to find return in fixed income. But we've chosen then to be in the slightly conservative high yield space for our approach. So in the 3 to 4 yield range is kind of the target, and then you have a slight span. So let's say 2 to 5 is our kind of focus point for us there. So the added value of ESG, and this is difficult to define, and I believe this will play out over time. I think this development has really exploded in the last 12 to 24 months. The focus area from the financial industry has been huge, and we're seeing that. And that is the point. One can make out and find faults in many of the things and development that has happened in the past 12 months. And not everything is going to be a good solution here. Excuse me. But I think you cannot underestimate the power and the amount of capital that is coming into play. So why did we choose the Swan Eco label here? And I think accountability is one of the words that you're going to hear maybe a few more times here. And this is what we wanted. We want to be accountable to somebody. And we also felt that we wanted to partner. That's another word we're going to hear here once or twice. We want to find partnership with people who have done this much longer than we have. So the Nordic Swan Eco label has been involved in products for 30 years, and then they went into the financial industry. And then it was the focus on equity funds, but they do make a distinction there. So we liked that approach, that it was reality-based, and they made a distinction between fixed income funds and equity funds. So in 2018, there were 20 equity funds with the label, and then we were able to be the first fixed income fund here in Norway and Sweden to achieve the Nordic Eco label. So now we've had that accountability for several years. So I'm going to see how that plays out when we talk about the SFDR then. So remember again, we spoke about the insufficient data to cover the entire universe. So this is also where under the preconditions with the Nordic Swan Eco label is that we have a full-time ESG analyst that takes this holistic approach and includes everything that we have out there, but that we do 100% analysis on every single one of the companies that we own. And then here, the big one then, what is the value? Because in the end, again, we're trying to achieve a positive rate of return in some shape or form for the shareholders. So what is the value apart from the feel-good factor? So this is not meant as a check the box thing. We did not set up this strategy 5 years ago to start a green strategy. This is because over time we've seen that we're trying to find the winners of today, but above all, the winners of tomorrow. And that is something that is extremely important here. We bondholders do not have voting rights, but we can influence in different manners. So I think engagement is also something that is going to grow over time. And there we see with our hybrid approach that we can actually fulfill a role here. We do get to speak with every single company. So actually yesterday there were two extremely dramatic events and most probably history in the making here. In Holland, a Dutch court found Royal Dutch Shell had not done enough in terms of the carbon limitations, so they ruled that the company is obliged to drop their carbon footprint by 45% by 2030. That's a landmark case that most likely will have ramifications around the world later on, in terms of that the court system is now stepping in. Second of all, on the ExxonMobil annual shareholder meeting, there was a bill for an activist to get board seats. Now, that's not unusual. The unusual part here is that the holding was 0.02%. This was tiny. This was a puny investor, but the puny investor had a very, very strong message and support of many others. And what seems to be the case, if this plays out as it seems from last night, this investor gained 2 board seats, and that was despite fierce opposition from of course, management and some of the other owners. Now, again, coming back to the thing, you don't have to be President Biden or somebody else. You can actually be a small investor. You can be Pareto Asset Management, and you can be somebody else who are able to find a voice at the table there. So I'm just going to read one of the comments from it. Exxon's climate targets were distorting its long-term emissions trajectory, and its claim of being in line with the Paris Agreement fails the basic test of logic. Now, that was pretty hard. So again, we have the opportunity to voice our opinion here in these matters. So it's twofold the value we would claim. So the third question we posed in the beginning, that was then what does SFDR Article 9 mean? Now, the financial industry must be the most innovative ever in acronyms and 4-letter abbreviations. So this is probably the 10,555 abbreviation here. So Sustainable Finance Disclosure Regulation. We are not in this time frame going to go through all of that, of course. But again, think of it as accountability. Europe and the EU has decided that everybody should do their part, and they wanted to start with the financial industry and then move to the corporates in 2022, and that's part of the greater taxonomy, and so it's a part of a bigger project. And in the end, instead of getting lost with what we're trying to achieve here and all the details, it is that we're on an unsustainable path. So everybody has to kind of do their thing. So the SFDR tries to provide transparency, minimize greenwashing, and to classify financial products in some sort of format. So the Article 9 is the highest classification in a sustainability objective, and then it's then called dark green then. So the fund Pareto ESG Global Corporate Bond did achieve an Article 9 classification according to the EU system here then. And this is what we are trying to honor our commitment here going forward. But I think we've been helped a lot along the journey with the work with the Nordic Swan Eco Label. Remember again, accountability. Now we have the accountability towards the EU and so forth. So part of the engine that is driving this is of course our ESG analyst, but we also wanted to share here that this is part of something that we do together, and the process is ingrained in all of us, and that's why all three of us are here. But please, now.
Yes, thank you, Stefan, and good afternoon, everybody. So I'm Nawel, and I'm in charge of ESG for the fund. As Stefan just mentioned, the fund has been classified as an Article 9 project, and I think this reflects that companies' carbon emissions are critical for our ESG analysis. As part of our sustainable strategy, we engage Trucost to measure the carbon footprint of the fund. As you all know, the carbon measurement will become a disclosure requirement by the end of the year, and we wanted to have a baseline against which to measure our relative carbon footprint, but also companies' improvement. So the first objective here is to be able to show concrete progress to our clients by the end of December. We also use this report as a tool for the engagement dialogue we have with companies we finance. That is why we consider this collaboration as a partnership for the fund and for the shareholder for a better future. So now about the report. So the report enables you to calculate your exposure to carbon that you have by investing in the fund, but you can also calculate your possible stranded assets thanks to that. The report includes several interesting and useful elements. I'm going to make some comments on the results, but feel free to get back to us to get the full report. So here is the fund carbon intensity against the one of the benchmark. The fund is represented in light blue and the benchmark in dark blue. The graph includes the three most common methodologies used by the market participants to assess the carbon footprint. So depending on the methodology you will use, the result will differ, but in the end, the conclusion is the same. As Trucost conclude in the report, the fund is less carbon intensive than the benchmark across the three methodologies used here. And according to them, this is due to a combination of a positive sector allocation effect, but also thanks to a positive instrument selection, which means that for the same sector, the companies that we have in the portfolio are less carbon intensive than the ones of the benchmark.
Yeah.
Thanks, Stefan.
Okay. Yeah, thanks now. So in order to summarize, again, we've tried to partner with global leaders and some of the best in the industry for this. And that we have then chosen the Nordic Swan Eco Label and then Trucost here as now described, because we don't have all the answers. But what we have then is a foundation for a very strong ESG framework to identify the winners of tomorrow. Now, if we can, over time, identify companies that do things slightly better every step of the way, and then also do it slightly better than their competition, most of the time they will then win the race in a financial sense too. So then it's ingrained, of course, in trying to drive shareholder return for the fund as well. I think, and it's been proven here, I think accountability will continue to evolve. We are very humble that we don't have all the answers. Definitely not. We learn every step of the way. We try to partner with a specialist in the world. But we also wanted to have a little bit fire underneath us and drive us forward in order to continue to evolve ourselves. I think that is progress is by far the greatest achievement of humankind, of course. And ESG engagement will continue to increase in fixed income. We talk often, now I gave the examples of Exxon, that was of course an annual shareholder, but we have examples where we sit in meetings. We have been invited in pre-sum processes now by some of the biggest banks in the world in certain situations because of our profile in this arena. So we are getting a seat at the table. So again, ESG engagement, and then we can hopefully drive a small voice towards a slightly better future. So again, yeah, Matthias, you have some closing remarks and/or we have some question and answers here. Thank you very much.
Yeah, thank you, Stefan and Noel. We actually got quite a few questions, so let's try to keep the answers somewhat brief, and then our clients or listeners can obviously get back to us with more details. But let's try to get a few questions in before the time is up here. We have a few minutes. The first question I see here, Stefan, maybe you can answer this one. Do you keep bonds to maturity in the strategy?
Yeah, we'll keep it short. So the short answer is no. This is not a buy and hold strategy. This is not a loan fund. Now, there are other aspects of it too. The bond market is very dynamic, and companies repay bonds earlier, but we also look for other opportunities, maybe from the same company, further out on the curve and so forth. So look at the fund as a gardening work, which continues to try to evolve, while at the same time keeping the same type of profile. If we let everything go and have too much there, the characteristics of the fund will change. So two very important parts. Thank you.
Okay, great. And then we have one here from mainland Europe. How does the fund view the ESG effect on performance? Which letter do you think affects short-term versus long-term performance the most? I got to say that is a good question, and I saw it a little bit earlier, so I had some time to think about the answer, but it's a great question. And I'll try to respond in a fairly brief manner, but all obviously, that's the boring answer, are important to us. And we see social aspects increasing tremendously in focus over the last year, I would say. But I gotta say, when the governance part, the G, fails, it tends to be very, very sudden and unexpected and cause obviously negative price movements. So in the short term, I would argue the governance part, and long term, if we have to pick one, I would say environmental, because of there are not really any other option here in the long term. We got to fix the environment. But that's a quick answer to a very good question. But I'm going to move on here because they keep coming in questions here. So for now, maybe you can answer, what kind of ESG metrics do you report on regular basis? So, if you would say a few sentences, Noel.
Yes. So in addition to the exclusion list, our ESG scorecard includes 15 criteria. We also have the carbon footprint now as a metric. We follow the SDGs and also the green bond share in the portfolio. I think this one is important. Thanks to this one, we can measure the CO2 emissions saved through our investment. And some other, but feel free to get back to us for more details.
Okay, I'll see if I can get two more questions in before time's up. This one, Stefan, think about this one. How do you minimize the probability that companies are only greenwashing? I know we've been talking about this internally a lot, but do you have any nice insight for our listeners to avoid greenwashing?
I think, you're never going to know everything, but I think this goes to the core of an active manager. We get to talk to, and of course they're not going to always just tell you, but we get to ask some questions, and then we get to hold them accountable. So we ask for proof when we sit in the meeting, and then every now and then, we discover that it may not be as good as they claim. Excuse me. As they claim in their vision and everything. So I would say the engagement is by far our greatest tool. in that aspect. Thanks.
Yeah,
good question.
And here, when selecting a bond, do you focus on the company profile or on the objective of the issue? For example, do you take into account a good ESG company issuing a bond for a share buyback purpose? That's also a great question.
Yeah, I think it is. Yeah, it is the totality. So I think an extremely aggressive capital structure may not fit because of the risk profile of the fund. So again, all aspects. So this is not. Yeah, exactly. We don't just buy a bond just because it checks a couple of ESG metrics at all. This is part of a financial investment. So I think we can find great companies that also contribute in many ways to the world. So that is not maybe where we have only obvious holdings in the fund. We can find on the micro level some extremely interesting companies, like Jacob Holm & Sons. That CEO has done a tremendous amount of work in the last 5 years. That's a privately held company where we had discussions now for 6-7 years with them, and we've gotten close to them.
Okay. I'm going to read the last question. Certainly great questions, everyone, and I'm very impressed with the question that are popping up here. But here's one about Warren Buffett. I gotta finish with this one. This listener thinks our style has a Warren Buffett touch to it. Does it make sense to create long-term value to look at ESG risk factors and opportunities?
Yeah,
go ahead, Stefan.
I mean, yeah, but those are way too kind. Warren Buffett is an icon, and we would never claim, I think, in any promotion of the fund that we are a direct disciple of Warren Buffett. Now we can learn a lot from anything that he and others have done in terms of long-term perspective. I think this is where we can take some cues from. So yeah, we can apply that, and we've seen that in other companies too. How you take a long-term perspective and not only use this quarterly approach that you should maximize your profit in a short-term manner, and that will of course go towards the environment that you make investments. So yes, we learn a lot, but we would never claim to have instituted a Warren Buffett copy in the corporate bond world.
Okay, great. Well, our time is up. We have actually exceeded 30 minutes by a few minutes. I certainly apologize for that. I hope all of you found this webinar interesting, and thanks again for dialing in. We at Pareto Asset Management, we look forward to talking to you all again soon, and thanks a lot for listening. Have a good day.
Yeah,
thank you.
You too. Thank you.